Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Hello, welcome to our session on 412E3, fully insured defined benefit plans. How much money do you think you need for retirement? Let's start there. These are great plans for putting away money for retirement on a guaranteed basis, whether it be $1 million, $2 million, sometimes a little bit more. Right now we can accumulate about $2.2 million in a 412E3 plan. And the great thing about these plans is the certainty that they bring for business owners. When it's key to that business owner that they want guarantees, these plans provide guaranteed returns, guaranteed death benefits, and very predictable costs. Because all the funding of a 412E3 plan must be with level premium insurance contracts, and the funding is based upon the minimum guarantees in those contracts. So out of all the types of defined benefit plans, which we have here on slide 5, we have traditional, a couple of variations of traditional, we have the fully insured, and we have cash balance. Fully insured plans were always envisioned by the IRS as the true retirement plans. There's no risk here for the employees. There's a guaranteed promised retirement benefit that will be there. And they've been around for many, 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 many years, so almost more than 70 years. They come and go in favor with employers lots of times, depending on their confidence in the stock market. When people think they can make a lot of money in the stock market without undertaking risk, then receiving the guarantees in insurance contracts may not be as appealing. But in tumultuous times, where you don't know what the stock market is going to do and there is risk of loss, the guarantees can be very appealing. The maximum benefit we can fund to, this is a defined benefit plan. The only difference from any defined benefit plan is in how this plan is funded. So it follows all the defined benefit rules. That means the maximum benefit we can fund to in 2012 is the life annuity of $200,000 using a retirement age between 62 and 65. The contribution limit will be whatever is required to get to that benefit, and the maximum compensation we can recognize is $250,000. Now, how much will the contribution be? It depends. Depends how old the participant is when they enter the plan, what retirement age we're using, how many years of service they have, and what their compensation will be. Now, unlike some traditional defined benefit plans, first of all, on compensation, they use an average of compensation. Here, this is pretty much going to ride with their compensation as we go along. But we always have that $250,000 limit. So what exactly is a 412E3 plan? Well, it's a plan permitted under the special provisions of the Internal Revenue Code, section 412E3. It's the actual Internal Revenue Code section. This used to be section 412I, but it was moved a few years ago. I don't know why, but the IRS moved it to a different section of the code. The rules did not change, just where it is in the code changed. So you can now, if you want to look it up, go to the Internal Revenue Code and look at section 412E3. What that code says is that section says is that it's a defined benefit plan, but it has to do with the funding. The funding must be solely with insurance company contracts, and the funding for that plan will be based upon the guarantees in those contracts. Because of that, and because those guarantees don't tend to be very high, it often will produce the largest possible contributions. In a traditional defined benefit, the actuary will assume a market rate of interest. If that market rate of interest is higher than the guarantees the insurance company is giving, that would tend to reduce the contributions to that plan. Right now in this marketplace, guarantees and contracts probably ranging from about 1.75 to 3%. I know several carriers out there that are giving 3% guarantees. Now, one of the wonderful features of the 412E3, it's substantial, it's secure, and it's safe. It can generate the largest possible tax deductions. You can fund to substantial retirement benefits, a lump sum of about $2.3 million. You can have insurance in the plan. It is, after all, a fully insured plan, and all the premiums will be tax deductible. All the benefits are guaranteed. You have guaranteed death benefits, both by the annuity that's used to fund the plan and also by the life insurance contracts if you have them in the plan. As we know, the funding of the annuity contracts is guaranteed. There's a minimum guaranteed rate of return. And the insurance company bears all the investment risk. And as well as other plans, these plans have protection from creditors. So you get the great benefit here of all that security, very little unknown in your future when you do a 412(e)(3) plan. So what are some of the features? Just to go on, the retirement benefit is fully guaranteed. The accrued benefit in this plan will always equal the contract cash value. So if someone leaves early or the plan were to terminate early, the contract cash value will always equal the benefit that they are owed. You may only use qualifying annuities in whole life insurance. So you have to do these with a company that has products filed and appropriate for use in 412(e)(3). The annuity will have to be a level premium funding annuity. That's required under the rules. And if you include life insurance in the plan, which you don't have to do, it can be just annuity, but where life insurance included, only whole life is permitted. And they have to be of the same series, which means you cannot mix products from different companies. They have to be from the same company. You do not need an enrolled actuary here because everything is based upon guarantees. Contract dividends or earnings above the guaranteed interest rate will reduce next year's contribution. So that will be a surplus, and that's a good thing, and reduce the next contribution. These plans have low administrative costs because of their stability. Potentially the highest deductions possible. They do have required contributions. This is an obligation. It's not flexible. But again, they do have the advantage when you have the life insurance, you're doing that with tax deductible premiums that are part of the plan. So let's talk about that insurance for a second. How much can you have? The premiums, as we said, will all be paid out of the plan contributions. That's all tax deductible. Should the person die while the insurance is in the plan, all the death benefits, the net amount at risk, the pure insurance benefit, that's the difference between the face amount and the cash value, will be paid income tax free. If they don't die and they get to retirement, they may take the policy with them and keep it if they want to. The life insurance, by including in the plan, can accomplish three things. It helps fund the saving for retirement because the cash buildup in the policy is helping fund that retirement benefit. It's a very cost-effective way to meet a need for life insurance, whether it's inside the plan or outside the plan, just because it's cheaper to buy it in the plan because the premiums are deductible. It also makes the plan self-completing should the participant not make it to retirement and be counting on having that money there maybe for them and their spouse. Should they die along the way, the insurance would make the plan self-completing. Always have to stay within the incidental limits. We prefer to use Revenue Ruling 74307 because it allows for additional insurance. You don't have to worry about these calculations. These will all be done both when the plan is designed and the proposals are run and as the plan is administered. But when you do put insurance in the plan, it will provide the death benefits from day one. And the cash value in the policy is never lost because that's used to fund the retirement benefits. So whether they take the policy with them or surrender it at some point, all that money will come back to them. So let's look at a sample case here. On slide 14, I have an owner and 2 employees. This would be a typical 412(e)(3) candidate. If we did the plan with no insurance and just annuity only, you can see the contribution is $211,984. That is quite a large contribution. The owner's contribution portion is $196,132. Very much in this owner's favor. Now, if we add in insurance to this plan, it drives the contribution up to $259,798, with $241,778 being on behalf of our owner. That is providing them with $2.3 million with a lump sum of $2.3 million at retirement. At age 65, and almost $4.6 million of insurance coverage along the way. For employers who want the maximum deduction they can get, this would be the route to go. The fully insured plan with life insurance will give them the highest numbers and obviously substantial benefits. Now let's look at what that really costs. If we look at slide 15, we can see the total plan contribution is $259,798. But that would give them a current tax savings in a 34% tax bracket of $88,771. Compare that to how much is being contributed on behalf of those two employees, which is only $18,020. The contribution from the owner is $241,778. But the net after-tax cost after taking into the tax savings is only $171,027. So costing $171, benefiting from a contribution of $241. It's pretty nice leveraging on behalf of that owner. Now looking at the insurance, by putting the insurance in, it increases the plan contribution $47,814, all of which is deductible. So, take about a third off of that for the tax savings. To figure out that, really costs them out of pocket, maybe in the mid-30s. The actual premiums for this insurance are over $141,000. So you can imagine if this business owner needed that $4.5 million for some reason and were to buy it outside the plan, they would have to come up with far more dollars to buy that coverage than they could here in the 412E3 plan and still get the same benefit. So who is a candidate? Typically a good candidate, these tend to be smaller companies, typically less than 5 employees. I have occasionally seen them go higher, but the typical candidate has 5 or less employees. They have high, stable profits, an older owner, younger employees. They want that big deduction. They have the ability to pay the ongoing contributions, and they're willing to commit to at least a 5-year contribution, preferably in the 5 to 10-year range for that plan. Who's not a good candidate? Large companies with many employees. Fluctuating profits, which means they might not be able to commit to that ongoing contribution. A young owner just, the numbers won't go that high. They won't be able to get that much here. Somebody wanting a one-time high deduction, not a legitimate candidate. This has to be a legitimate ongoing plan. Any reluctance or inability to commit to those ongoing contributions would certainly not make them a good candidate. So look for those clients who are profitable, have high cash flow, older. This will begin to work for people in their 40s. Certainly works extremely well for people in their 50s and 60s if they want those high dollars. Again, it's going to save them taxes, puts the money away out of the reach of creditors, gives them all the guarantees. Everything is protected. It's a very, very secure way for them to accumulate tax deductions today and accumulate savings for tomorrow that they'll be able to tap into and use when they retire. So again, to broach the subject with an employer, are they interested in saving taxes? Would they be interested in the guarantees? How much could they contribute? How much would they like to contribute? Are there particular employees they want to include? Who do they want to favor? And then we need census, date of hire, date of birth, and salary for all the employees. And from that, we can run a custom plan design and see how the numbers play out for that employer and see whether this will work for them. We always look at all the options when we run a design, so even if you request the fully insured, we're going to look at traditional, probably even a profit sharing to make sure we find what is the best solution for them, just in case it isn't the 412. If they want to move ahead, they execute the plan document, you put in the applications for the insurance to start that process going on, get the plan established, and then there's ongoing administration to maintain it. Just remember, if they're on a calendar tax year, they must establish any plan they want by the last day of their fiscal year, which will be December 31. So make sure you allow enough time for that employer to see the proposal, decide what to do, get that plan document ready, and get your insurance applications in. Please call us whenever we can be of help. We're always here and always available and always happy to help you. It doesn't cost you anything, doesn't cost the employer anything. Please give us a call. Thank you. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.